Today, for our Tech Business Roundtable FinTech edition, I'm excited to interview Arcady Lapiro. Our topic today is FinTech funding, valuations, and opportunities in 2023 and beyond. Arcady comes to us with 20 plus years of experience in FinTech. He started one of the earliest digital banks out of Europe approximately 20 plus years ago. Currently, he lives in New York, but he's originally from France, and he has a company that focuses on providing white label solutions for small community banks and credit unions, Agora services. Plus, he's also the advisor for a private equity firm with a $3 billion fund to invest in fintech companies. So he has a lot of experience, firsthand knowledge as to, what does the funding environment look like in 2023? What do valuations look like? And what are the opportunities that, are getting funded, that are getting traction? So, Arcady, welcome to the podcast. And I'm really looking forward to our conversation today.
Thank you guys for having me.
Before we get started, tell us a little bit about yourself, specifically what you do with the private equity firm. And I know you have been doing this for a while. Give us some color and I know you also in the prior bank ended up buying 6 other companies when you were with that. So tell us a little bit about your perspective on the entire space of funding, valuations, and opportunities.
Yeah. So I'm from some time, let's call it this way, in the industry. Early 2000, I was part of a funding and management team. We built a digital bank that we grew from scratch to over $20 billion deposit in 8 years. We acquired a lot of competitors. At that time, early 2000, there was a lot of funding, then there was a crisis, then there was a lot of merger and acquisition, valuation were halved. And this is exactly what's happening today. So it's the same scenario. So people are just like looking at what's happening today. We're seeing FinTech is crashing down, valuation are crashing down, funding is crashing down. It's just history is just repeating. So in my past, we acquired a few competitors, few online banks, FinTech at that time. This year, I'm advising a private equity, which is investing in FinTech and financial services. So I'm trying to stay informed about the valuation. Aside my day-to-day operational life at Agora Services, which is our FinTech.
Thank you for that. Thank you for that introduction. So we are recording this in early September 2023. What does funding look like? I mean, are companies getting funded in FinTech right now?
No. No. There's always funding, but the situation is not good. There was tons of money with because of interest rate, which were 0 to negative, negative to 0. So it was free money. So there was a lot of money at the end of private equity VC, and there was a lot of competition to invest. And there was a FOMO, a fear of missing out. So valuation were going higher. It's crazy. Term sheets were going fast. And then suddenly the Fed stopped the game, raised the rate, and now money cost. And at the same time, in the cycle of FinTech, all these FinTech were funded with a business plan which was not proven. And they faced a reality, which is like, where are the revenues? Is it a sustainable model? Do the clients want to pay for it? And so at the same time, you had rates, money cost, funding is not as easy as before, and impact on valuation. So there was a huge slowdown in VC funding for FinTech. I'm not going to elaborate on other segments, but I'm not an expert. But regarding FinTech, if you take a look at global funding in first half of this year, it's nearly halves to 23 billion. So it's like it's a big reduction. Does it mean that FinTech is dead? No, FinTech is not dead. FinTech is here for good. But what's going to change? It's how various companies are evaluated. What's the business model? Is it going to be B2C or B2B? Is it going to be B2B SaaS model or not SaaS model? So that's going to be the key thing. So If you VC, you're not going to look at B2C, mostly at B2B. And if you're looking at a B2C model, you're going to see a model where you have a subscription model versus a free model. So a lot of, it's not a revolution. It's something that happened already 2 decades ago. So it's just funny for me to see that people are just surprised about the situation where it was just expected.
Right. So when you say B2B, let's elaborate on that. You mean like providing services to other financial services companies, let's say banks, mortgage companies, etc.? Is that what you mean by B2B?
Yeah. So B2B, it's business to business. You provide services to corporate or institutional, and this institutional corporate can have end users, but you provide the service only to this corporate or financial institution.
Right. So you see a lot of demand there, but you're saying B2C is really tricky, especially those free business models are getting clobbered, and perhaps there are some room for subscription-based business models. Can you give us some examples of some?
I'm going to give you a very basic example. Neobanking. So all these digital bank that exploded in the US with a free model. So they were going after migrants, after Chinese, after mainstream, after solo professional. So names are, you can say, Chime, Current, Greenlight, which was targeting the teen account. So most of them are doing a free model. That means you don't pay anything. So they're making money on the interchange fee. That means every time the end user is swiping his card. Some of them have a subscription model, which is a good idea, and especially when you have this kind of market. So for example, Greenlight has a subscription model. So the parents are paying for the cards of the teen. So that's a good model. All the teen account, there's several players like Step, Cooper. It's a free model. So an end user is not spending a lot, a teen, and at the end of the day, you don't have a subscription model, so it's complicated. Same thing on the entrepreneurial world. So for example, you had several small medium business neobank that launched, and some were a free model, some of them were making a subscription model. So for example, there's one in Europe which is very big. They already made their first FinTech acquisition last year, and they're expanding right now in Europe. It's called Conto, which is amazing. That means it's targeting only this small medium business, and every customer is paying. Even before banking, they're paying right away. So that's a very virtuous model. This is a free model when you don't have a funding from the VC and the client is not paying you upfront. You can make only money on the interchange fee, and at the same time you have the inflation. You have this is for retail client, not for the small medium business. But if you're targeting the retail customers, they're spending a little bit less, and you have your cost on the other end with all your providers, and there's no subscription model. So it's getting complicated, tricky if you don't have the funding from the VC anymore.
Right. Where do you see opportunities for innovation in FinTech? Like, I mean, at a 10,000 foot level, like, I mean, of course, we all have most of us have, banking relationships. These are traditional banks. They do everything from small business banking or big business banking to, mortgages, loans, all of it, right? There is an office, there is relationships with specific people in those banks. How do you think things are going to look like, let's say, 10 years from now or 20 years from now in FinTech?
In banking, let's say banking overall, because for me, it's like I don't make a difference anymore between FinTech on one side and bank on the other side, because banks are adopting FinTech strategy and technology. So for example, JP Morgan, the biggest US bank, they're spending today $12 billion on IT per year. $12 billion. Not everything is FinTech. It can be maintenance, it can be upgrade, it can be recruitment, it can be acquisition, investment, but it's still 12 billion. So they're adopting a FinTech strategy, even certain features. So where do I see let's start slow. In 10 years from now, and this is exactly what happened in 2000. It's like where do you think the innovation will come first or faster? The way I see it, it's like it will be behind the scene for the end user, because the banks, especially, the way they would see it, it's like how can it benefit to the end user? No, the way they will see it, it's how I can reduce my own cost. So what I see in acceleration in the next 10 years, it's everything about automatization within the banks, AI automatization on the back office, on onboarding, on control, on fraud, on chatbot, on everything. So this is, I see it not even 10 years, but in the next 5 years, massive. Now coming back to next step, which is 10 years, how do I see it? It's like if you're looking about the US market, we are focusing the US market. There are approximately 10,000 banks and credit unions today in the US. All of them have branches. And this is an official data. In the next 20 years, around 50% of these banks and credit unions are going to disappear.
I'm sorry, you said 50% of bank agents?
Yes.
Will
banks and credit union.
Okay.
So we're not talking about the European model where you have not so many and suddenly 50% doesn't make a lot of change. Here in the US, you're talking about around 10,000 banks and credit union today. Just to put in perspective, in 1995 it was 14,000. So just to give it. I want to scare people. Today, it's approximately 4,500 banks, not credit union banks.
Gone.
Today active, still operating. In 2075, the projection is 438 banks. Only that's 200 in 50 years from now. 50 years from now, that's a projection, but that makes sense if you compare to what happened in Europe. It's like if you're taking a country, for example, like France, which is 1/5 of the U.S. population today. In France, you have more or less 150 banks, legal entities. These banks can have subsidiaries, affiliated companies, but as a main bank, around 150, and it's just 1/5 of the U.S. population. So just it's not the same geography, it's not the same history, but there's a trend. So now the question is like, you're a bank, you're a credit union. What do you do today? So what I see, it's really like on the financial side, it's like either they're going to close purely and simply, or they're going to invest in technology, and that's where the FinTech has a play. To be a partner of these banks and credit unions, to help them to reduce their costs, to help them to be able to compete with a big one. It's like, how can you compete with if you're $300 million asset credit union or community bank? How can you compete with JP Morgan with $12 billion IT? You need to be smart. You need to have a niche. You need to have specific solution and focus on that. So that's why I see in the next 10 years acceleration of FinTech intrusion or collaboration with these banks and credit unions to help them to survive and to focus on what's key for them, to reduce their cost, key for them, and to be able to survive. Now, if you're looking on the FinTech side, pure FinTech, the big neobank, the big digital bank like Chime and Current, for example, they're going to stay and they're going to step in and to provide more services and to gain more clients. All the rest of the mainstream, let's call the mainstream neobank, they're not going to make it. They're going to disappear. And this is exactly what happened 2 decades ago with what was called the online brokerage. If you remember, there was Schwab. So, but at the time of Schwab, how many online brokers you got? You got like 50, 60, and all of them got small customers, and all of them were saying it's free. And at the end of the day, there was not so many. TD Bank just sold the TD Ameritrade, so Schwab is absorbing them. So even if you're a big one, down the road, even the big one absorbed by the other one. So the conclusion of TD Ameritrade, it's coming by the way this weekend. This weekend they finalized the integration of TD Ameritrade within Schwab. That was this weekend. So it went fast. So the FinTech, it's like they're going to be, the big are going to get bigger, the small are going to, FinTech will have to focus on the very niche market and with a dedicated offering, with dedicated products and Hopefully for them, they would be able to price it to charge for end user. Not every end user wants to pay, but hopefully some of them will be able to do it.
Makes sense. Makes sense. Let's talk about the funding side. Do you see a lot of angels? Do you see a lot of small early stage VC firms, or do you think it's like you have to really have a product and customers before they're going to look at you as funders, as VCs?
So everything depends on your stage. So if you're talking to angel, by definition, angel are here for when you don't have a product or you're about to build a product. But today, everybody want to reduce the risk. So they want to see more traction and a product fit, not even a product fit, and to feel more comfortable. So many VCs which were focusing on pre-seed or seed moved away to go to Series A because it's less risky for them. That's one. Two, it's like you may have on the paper, VCs out, website with a phone, they claim that they have money. The reality is that today it's not a new concept, but the word is coming back. It's called VC zombies. That means they don't do anything. They're just here to grab information. But it's a technical word. You Google it, you will see it's called VC zombies, and you have many of them. So many VCs are going to unwind in the next few years because they invest poorly. With some of them, not every VC is a great VC. A lot of them are doing a good job, but a lot of them made huge mistakes. Even the big one made a huge mistake. If you take a look at one of the biggest investor in technology, which is called Tiger Global, it's a nightmare what happened to them last year. It's with FinTech now. Same thing with SoftBank. A lot of investment from SoftBank went to the wall. Just take a look what happened recently with WeWork. They're declaring that they can't even bankrupt today. So there's a move from VC to it's like an investor. When you invest, you're looking for safer assets. So there's a flight to the quality. So there's also a flight to quality from VCs. They want to invest in a more mature market or generating revenue or sustainable model, or if you're not generating enough revenue, but at least you show that you kill the market and you nail it and you can really expand it, and no competitors today can come after you. That's where we're going. So it's a flight to quality.
Makes sense. Makes sense. Is it possible for, let's say, a young person without institutional backing to come in and disrupt and do something in FinTech today? Or is it really, really hard because of, you talked about the biggest getting bigger and, and so forth. So with these macro trends, is there possible for like total innovation and somebody like in a garage, like Stripe, for example, to show up and do something interesting?
Theoretically speaking, yes. The question is like, if you build something which is not saying unique, if you build something which is as a hedge, technological edge or product edge, and you're launching it, and there's a market fit, and the competitors cannot copy you. Theoretically speaking, there's still a way to go. Is this person is going to find easily a funding? No, funding today is complicated for everyone. So I cannot tell you which sub-product or which sub-segment is could be a good fit, but AI definitely. Take a look at AI. Today with AI, you cannot do anything with small money. You need a lot of money to do AI. There was there's a FinTech in Europe, which raised, it was like 2 months ago, 100 million pre-revenue, no product, no team. It's AI. So it's so if today you want to launch an AI solution, and you need to raise money. So it's not that you're not coming with one computer in a garage and you build an AI solution and that's it, you're killing the world. That's not happening.
Right. Let's kind of switch gears to AI for a minute. What do you see right now? I know you talked about automation, cost savings. That's a huge trend. Anything specific? For example, I know robot process automation, right? A lot of manual duties are being taken away by robot processors. I assume that's going to trickle down from the big banks to even the community banks and the smaller players, because they can't compete without creating those savings. Anything else you're seeing in terms of any big parts of how banking of FinTech was happening that you think would be automated completely?
I'm going to say as a joke, when crypto, Bitcoin, was at not the valuation of today, but $40, $50, $60,000. People were saying crypto is going to cure everything, even AIDS and cancer. So that was the thing. Crypto is going to save everything. So today there's a word. Not today. It's like there's already a slowdown. But a few months ago there was a craziness about AI. By saying AI is going to revolutionize everything and it's going to kill everything. AI as a concept is not new. If you remember the movies from the 70s,
Yes.
there was AI there. There was AI. If you take a look at the 2001 Story of Space, R was the acronym of IBM, was there too. Early 2000, end of 2000, 2008, 2009, IBM was coming with Watson as AI. And they were going on the, they were saying they were doing revolutionize everything with AI. So the difference today is way more data. So you need the data to fine tune the AI. Computerization is way more advanced at that time. So you don't need but today you have everybody's running after the chips because you need more chips. You need to buy chips. You need to buy chips to compute. But there's kind of difference. It's like it's cheaper today than it was before, and it's kind of more accessible. So if you're looking at ChatGPT and OpenAI corporate, it's not so expensive for even not a bank, but for a company to leverage AI. It's not. It's becoming there's a democratization of it. So now it's like the use case. Is AI going to save the world? No, I don't think so. It didn't. It won't. Who's going to save the world? It's us, human beings. But that's another story. That's not FinTech. That's called. It's other issues. It's political issues. So regarding AI, so really it's like whether it's going to be real use case and proof of concept, it's cost reduction. There's going to be also leveraging AI, and there's a fear of that on everything about credit scoring and mortgages. So it was even funny that the regulator came like a few months ago by saying they warn banks and lenders by saying don't abuse AI to do red taping, to not give access to credit to certain people. Like before, there was no red taping manually or with an Excel. You can do that, but AI by itself is bad. That was funny for me. I even posted on LinkedIn about it by saying like it's not AI which is bad. It's the way that AI is used. So so it will be always there's going to be a lot of discussion, I believe, about how AI is used and how AI is disclosed to the end user, because they would like to know. It's like if it's a machine, they want to know because how the data is handled.
Thank you so much. As we bring this to a close, any final thoughts to entrepreneurs, VCs, anybody in the fintech space? If you were to give them any takeaways, sitting where we are sitting in September of 2023, any pieces of wisdom? What would you tell them?
Yeah. One piece of wisdom: fintech is not dead, and on the contrary, fintech is going to boom and to explode. That's not just me and wishful thought. It's market data. It's market data. So and it's just a cycle. So the question is like, do you have to do B2B, B2C? Definitely, I would suggest to do B2B. But fintech by 2030 is projected to be a 1.5 trillion industry overall. Not everybody is going to be a winner at every segment, but it's the market is coming. So it's and it's a study by BCG, which is a consulting firm, as you know,
Boston Consulting Group. Yeah,
exactly. So it was a few months ago. It was not like that's 4 months ago. So today, fintech revenues are 245 billion, and it's projected to be within 7 years, 1.5 trillion. So fintech is here. So really, I would focus like if you're an entrepreneur, it's like one. I believe go after what was not served today. So some category or niche which is not served. What's one? Two, have a business model where you can price or charge the end user or the corporate. And 3, have a scalable solution, and 4, the right partners. That means if you're B2B model, B2C, it's like there's a different way to do partnership with banks, community banks, digital players. Strike as many partnership because it's always easier to leverage additional network than create your own network.
Makes sense. Thank you so much. Really, really appreciate your time today. And I also wanted to take a moment to thank you for this wonderful podcast and the conversation we had today about fintech funding, valuations, and opportunities in 2023 and beyond. I also wanted to thank our listeners. We cannot do what we do without you. Until we meet again with another amazing Tech Business Roundtable episode, I'm your host, Naren Arul Raja.